Here, how are you feeling today? I'd like to make sure you can hear me, so please find yourself the Q&A box and say hello to let me know that you can find the Q&A box so you can participate today and that you can hear me. Hey, Maria. Nice. Oscar, thank you, sir. Julia, hello to you. Thomas, hello, hello. Juan, hello to you. Oh my gosh, you guys are so friendly today. I can't even believe it. Well, I'm going to be friendly right back because we have got a great presentation for you here today. We are, hey, Vittorio and David and Jose. Okay. So we have got a great presentation today. We're going to be talking about trading a winning credit spread system. Now, before we get started, I need to point out that options are not for everyone, and you should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Now, I see some familiar faces here today, but I see some new friends too. So, welcome, new friends. Allow me to introduce myself if you are not familiar with me. My name is Dan Passarelli, and I am an author of two of the top options trading books. Working on the third coming out in the spring of next year. One I'm most known for is Trading Option Greeks. And I'm a trader. Been doing it for a long time. I don't even want to tell you how long because you'll think I'm old. But I've been trading for a long time. I've traded professionally down on the floor of the Chicago Board Options Exchange and the Chicago Board of Trade, CME Group, traded upstairs for a very small hedge fund scenario. Now I trade. Hey, Larry. Hey, nice to hear from you, my friend. I trade in a regular old retail trading account, just like you do, which is great. We've got that in common. And I am the founder of Market Taker Mentoring, which is the global leader in option trader education. We have students in over 50 countries, if you can believe it. And we've trained tens of thousands of folks, hundreds of thousands at this point who've been doing this a long time. And we're here to help you as well. I am a trading industry collaborator. I work with the best options friendly brokerage firms out there, like, for example, Firstrade and others. And I work with the top options exchanges in the world. Maybe all of the options exchanges in the world I've had some sort of interaction with professionally. That's quite a crazy statement, but I'm trying to think if there is one that I haven't worked with. And I'm hard pressed. And that said, I do other things besides trade and help you trade. I am a family person. That's the important stuff, right? And my wife, Kathleen, who those of you who are market taker mentoring student traders are familiar with Kathleen, my two adult children. And I do other things for fun besides family and trading and teaching. I'm a runner. I was up early this morning getting a short run in today. And a foodie, which is why I have to run. And a traveler, been kind of all over the world, either with my family or friends or through my work with Market Taker. And I am a music person as well. Gardening, I don't know. I do lots of crazy stuff. But today, the craziest thing I'm doing is talking about credit spreads. And I've got a super crazy thing here for you. I'm going to give you a free gift. This is in addition to everything you're going to learn today in today's training here with Firstrade. I also have a little party favor. Go to markettaker.com/guide. Market as in stock market. Taker as in take what is rightfully yours. That's two T's in a row. That second T is for theta. Markettaker.com/guide and get this free guide on option credit spreads. It's a really, really great explainer that complements everything we're talking about today. In the meantime, here comes your crash course. There are two types of credit spreads: call credit spread and a put credit spread. A call credit spread is when a trader sells a call and buys a higher strike call. Both of the calls have the same expiration, and both of the calls are on the same underlying instrument. And then there's put credit spread. That is when a trader sells a put and buys a lower strike put further out of the money, both in the same expiration on the same underlying. Typically, all the options are out of the money. They can be kind of close to the money. They can be pretty far from the money and anywhere in between. I mean, they could even be at the money or in the money. All right, Vittorio. Excelente. Eccellente, right? Is that how you say it? Eccellente? I don't know why I'm assuming that you speak Italian. I speak a little bit of Italian. You know, I try. Un poco. Okay. So all that being said, they can be in the money. They can be at the short option can be in the money or at the money, but they're typically both out of the money. And here's the idea. This is like the big secret to credit spreads. You sell them, you collect the credit that sits in your trading account, and if the stock is, if none of the options are in the money at expiration, the credit that you received is yours to keep. The options expire, the credit doesn't. And so if you do these credit spreads over and over and over and over again, and they work out, you build wealth. Now, they're all not going to work out. So we have to learn how to put in ones that have the greatest chance of working out, how to find them, how to set them up, how to trade them, how to analyze them, and also how to manage them. Management is what makes money. All right. So, exposure of credit spreads. We're going to talk about a couple of things here. Usually we show these like profit and loss diagrams, and we will show some of those. The best case scenario is, like I said, you sell the spread, everything expires worthless, you keep the credit, move on. But in the interim, you've got other risks and profit sources to contend with. First of all, there is delta. Who can tell me what delta is? What is the classic definition of delta? It's a race. Let's see who can do it the fastest. The fewer words you use, the faster you're going to be. I always prefer when people type in something nice and short. Then I can just read a nice little soundbite. Vittorio, that's the next thing that's one of the next things we're going to talk about. Mike says change. All right. I said a few words. I mean, but you need another word or two there. But you're on the right path, my friend. Costas is back. Hey, I had a good friend named Costa when I was in college. Sensitivity of the option to the underlying price of the underlying. Pow! Costas, boom, right on the money. Maria, ooh, Maria, I like what you're talking about there, Maria. Probability of being in the money at expiration. We'll talk a little bit more about that one later. I like that one. That's what I call the trader's definition. All right. And thank the rest of you for the answers that you threw in there. Ooh, first derivative. Oh, Juan, look at you, Mr. Mathematician over here. First derivative. I like it. I like it. All right. So, delta is how much an option trade, whether it's a single option or a spread, makes or loses as the underlying goes up or down. If I have a call credit spread, I have a negative delta. If the stock goes down, I make a little bit. Stock goes up, I lose a little bit. Then we have who is that before? Maria. No, was it Maria? No. It wasn't Maria. Oh, geez. I always delete these so that, I don't clutter up my screen. I think it was Vittorio was talking about a very, very important thing. This is how, I mean, these are the risks, but before we get to volatility, how do we actually make money? We make money by time passing. As each day passes, options lose their value. Now, they might make or lose money based on delta, but independently, options get worth a little bit less as each day passes. That's how we make money. Theta, thank you, Larry. I appreciate that. I appreciate you. Theta. And then that finally brings us to volatility in Vega. Now, volatility, oh gosh, that is a tricky one, friends. That is a really, really tricky one. Let's talk about volatility. What does volatility mean? Well, I mean, on its surface, and as a practical option trader definition, it means how much the stock goes up and down. Is it big moves or small moves? And that is indeed volatility. And that very, very lay regular guy definition will serve option traders pretty darn well. That type of volatility is called realized volatility or historical volatility. If the stock's crazy moving all over, what is a stock that has a lot of a very high historical volatility? Can anybody think of one? What is a stock that has some pretty crazy Nvidia, Tesla? Oh, hold on a second here. NVDA, is that true? I always thought Nvidia was a quiet little boring old stock, isn't it? Let's take a look here. I got on my other screen over here. Uh NVDA. Oops, I'm in the wrong thing. I start typing stuff in the wrong thing. What's the matter with me? Oh, this. Here it is. Here it is. Nvidia stock. Okay, so we started out the year, well, basically the year. Hold on a second here. Let's get to the beginning of the year. Here's the beginning of the year. We started it out with Nvidia at what? What's this date? January 2nd? No. We got to go back to December 31st. Closed at 134.29. Few days later, it was up 10 bucks, like 7%. Geez Louise. More than that, actually, at the high. And then it was down below that. And then look at this major gap. And then, oh my gosh, within a period of 2 weeks, we went from a low of 116 to a high of 143. Oh my, that's like a 30% move in like 2 weeks, and then down to 90 and up to 171. Oh my God. Yeah. Okay. Costas. Yeah. That is a volatile stock. Oh my gosh. Let's look at Victorios's Tesla. Is that true? No, Tesla is a super boring stock, isn't it? That stock doesn't even move, does it? Oh my gosh. Vittorio is spot on the money. This thing, the beginning of the year, wait, got to get to December 31st. That's how we always measure this stuff, right? December 31st closed at 403. A month and a half later, it was almost half of that. Now it's about 50% higher than the low 4 months ago. Vittorio, yeah, this stock is freaking crazy. Baron says, hey, Baron, how are you? Nice to hear from you today. Says CYCC. Ooh, what did I do here? CYCC. Oh, pharmaceutical companies. Oh, yeah, those suckers can be freaking crazy. Let's take a look. Oh my gosh, look at this. This is a typical pharmaceutical company stock, isn't it? Right? Oh my gosh, look at this. The first day of the year, it had like 100% range. And then in typical pharmaceutical stock fashion, it just sits here until, let me guess, it passed its stage whatever trial here, right? Probably not the fourth stage. It's 4 stages, I think, if I remember correctly. So maybe this was the first or second stage. You go back here. Yeah, that was probably like, yeah, probably past its first stage trial. Oh, and then it popped up here too. Oh my gosh. This thing is crazy too, Baron. Okay. So now we have a pretty good idea about what is historical volatility. And that's an important one because if the stock moves too much, it can blast through our short strikes and it can really foul up our credit spread trades. But there's another type of volatility. Don't you know it? What is it? Yes, I can read your mind. Did you know that I could read your minds? Baron says imply. It must have been your mind I was reading. There's somebody else's mind that I was reading, and I don't know. That guy was thinking some weird stuff. I'm not even going to talk about what that guy was thinking. But Baron and Larry had nice, friendly, productive thoughts here on implied volatility. Implied volatility is what? I had a professor in college who used to say that. Why? He was my economics professor. What do you think? Why is the supply and demand utility curve blah blah blah? Why? Why did he say that? It's the silent H. Silent H. All right. Anyway, so yeah. Oh, Juan. Oh, you're bringing up all these like things here. Juan is on fire today. Okay. So, right. People look at implied volatility and Larry's right on the money here too, as the expected move in the underlying stock, what the market anticipates, Larry, what the stock will do in the future. And that is theoretically true. But remember what Yogi Berra said. In theory, there's no difference between theory and practice, but in practice, there is. How does implied volatility change? Well, here's what happens. When a big firm like Goldman Sachs comes in and buys 20,000 options, well, what happens to the price of those options? Now, I'm saying the stock doesn't move, time doesn't pass, except for like the 2 seconds that it takes for them to buy 20,000 options. They're creating demand pressure, right? Demand pressure pushes the price of stocks up. That, friends, is the implied volatility factor, embedded in an options price. Now, classically, we make the assumption that if somebody's buying a bunch of options that decay in value, as Vittorio pointed out earlier, they must think there's going to be a pretty big move and probably pretty quick before it decays a lot, right? So it's intuitive that people would only buy options if they expect a big move. And if they don't expect a big move, they tend to sell options, which of course is what we're talking about today, isn't it? Isn't it? That's my British accent impersonation. Pretty good. What do you say? That's what we're talking about today, isn't it? I can only do it with one word. That's the only word I can do British accent, isn't it? All right. Anyway, so right, that is what implied volatility is. It's the supply and demand input of an option price. If the stock goes up or down, the price changes because of delta. As time passes, the price gets cheaper because of theta. As supply and demand happens, prices change because of implied volatility. Kostas says, also other market participants watch whales moves and think there's some non-public info this whale knows. I know that, Kostas, is actually how one of the methods that I use for trading credit spreads. I call it Credit Spread Genius. Those of you who downloaded that free guide on credit spreads, you'll get an email actually in the future that talks about using whales trades to find good credit spread trades. So we need to consider an attempt to profit from both direction and implied volatility. And if we're selling options, we're definitely going to profit from theta. Okay. Taking all that into account, there are a couple of things that we need to really focus on. First of all, as with any option trade that you will ever make, you need to know your maximum gain and your maximum loss. Now, I want to impress upon you that I really mean any option trade, because there are some option trades, not credit spreads, like selling naked puts or naked calls. Naked means not part of a spread, just selling a call and that's it. That's the whole position. Where you can lose, in theory, infinity selling a naked call. Truth be told, I have never yet seen a stock go to infinity. So I've never seen a loss of infinity, but they tell me it can happen. That's what they say. And they know everything. They're like ChatGPT. So maybe you won't ever lose infinity, but you can lose a lot selling naked options. So we always want to know, what is the most I can make? What is the most I can lose? And the whole point of credit spreads is that we don't like selling naked options. We don't like being able to lose infinity. We like to have defined risk. If you're taking notes, write that down. Defined risk. Now, we also want to have a high probability of trades. Let's take a poll. Would you rather have A, more winners, or B, more losers? You don't have to answer. I'm being a smarty pants. You want to have more winners, right? So we want to have a high probability of success. And we actually can do that with credit spreads. Now, we're talking about theta, time passing, making options worth less. Well, all theta's not the same. Typically, if the option is close enough to the money, selling options with less time give you a higher theta. That means you make a profit faster when theta works out. So my rule is I don't really like to trade any credit spread with more than 3 weeks. I've been known to every now and then, but almost never. 99% of my credit spreads are probably less than 3 weeks. And usually you're not going to find too many great ones with less than 3 days. I will trade them with less than 3 days, but they get a lot more challenging when there's less than 3 days to find one. You have to get really close to the money, and then it gets a little dicey. Also, we want no earnings announcements or other news expected before expiration. Earnings announcements they make the public aware of when earnings announcements are in advance, right? Your WXYZ company is going to announce their earnings on whatever, just make up a date, July 25th. Well, first of all, by law, they have to announce them once a quarter, and they want their shareholders or prospective shareholders to be able to know when earnings are coming out and when their conference call that goes along with it is. They want to share all the good news or try and spin all the bad news, right? Other things like Fed announcements, PPI and CPI, right? We just had inflation numbers this morning. For those of you who are watching this live, those things they're all scheduled. I mean, the Fed announcements, they get scheduled by the first of the year. You know what all the Fed announcements for the next year are going to be. They're all scheduled out way in advance. Those are the things that can cause big, big moves. When a stock has earnings, that can be one of the biggest moves of the quarter. Fed announcements, inflation numbers, the monthly non-farm payrolls report that comes out the first Friday of the month, these are movers. We don't like that. If we want to have a high probability trade, maximize our chances of making money, we might not want to have on a credit spread if there's a big news event coming out that can move the stock. So here's our setup. We start with, I say direction, but I don't know if direction is really the right word. We start with technicals and fundamentals. Start with the chart. If we're looking through charts, we want to find a stock that has hit support or resistance and bounced off it so that it has been established. And sometimes, the stock can go through it once or something like that. But if we see 2 or more points that the stock has bounced off of, whether higher or lower, that's support or resistance. We want to use support or resistance levels to set the potential short strikes, short options strike. Because what is support or resistance? It's a level, support is the level that a stock has gotten down to, but then bounced higher at least twice. The more, the better. Why would a stock bounce higher? Because there's buyers there. That's the only reason it possibly can happen mechanically. And sure, there's reasons for people buying. Oh, the stock's a good value there. It's got some technical thing that makes people buy it there. There's lots of reasons for it, but the super reason is that there's buyers there. Resistance, that's where the sellers are. So we've got this thing that actually gives us information to help us make money. Hey, in the past, when the stock got down to 60, it bounced higher because that's where the buyers are. Oh, if I sell a put that has a 60 strike and buy a lower strike put to create my credit spread, that support's going to help me to make money. Same thing with the call credit spread and resistance. And then it's not just the chart, but it's the fundamentals too. When I say fundamentals, don't worry, you don't have to look at financial reports, 10Ks or 8Ks or anything like that. You just have to look at the news. When is earnings? Let's avoid that. When is non-farm payrolls? Well, let's maybe avoid that. Now, who here is smart? Anybody? Of course, most of you are smart. In fact, I would argue all of you are smart for showing up here and putting in the effort, right? We've got a lot of smart people here. Me, they pay me to show up. You guys are the smart ones. You're showing up because you want to get better at trading or you want to put in the effort to make it happen. I love that. So, okay, all you smart folks, I'm going to give you an advanced concept here. Implied volatility, that's a little secret source of edge on credit spreads. If you can only sell credit spreads when implied volatility is overpriced, I believe you will do better in the long run. That is what my system is predicated on. We want to choose to only sell options when they're overpriced in terms of implied volatility. Okay, let's take a look at an example here. This is Airbnb. You guys like using Airbnbs? I love using Airbnbs. These days, anytime I travel, not anytime, but most of the times that I travel, like on a vacation or, with friends or family or whatever, I love using Airbnbs or, VRBOs or whatever. It's just like, yeah, I love it. Okay, so Airbnb, this is a chart of, not quite 6 months. Yeah, it's about 6 months, isn't it? Do we have resistance anywhere on this chart? Well, yeah, I would argue that about 140 is a pretty solid resistance level. Now, yes, on this earnings date, the stock ripped through it, but then came right back down. But then the level, the resistance level that was established here and here and here reformed itself and is holding. And yeah, you can get some wicks and stuff through resistance levels, and that's okay. It still matters. So, all right. How can I make money if I think A stock, hypothetical example here, Airbnb, is not going to go up above $140. Well, what about this? What if I sell a credit spread? I could sell the 140 calls at like $1.47 and buy maybe the 145 calls at 58 cents. 147 minus 58, that's 89 cents. But I'm going to let you in on a little bit of a secret here. When you're trading vertical spreads, which is the family of spreads that credit spreads fit in, if it's a call credit spread or a put credit spread, it's a vertical spread. If it's called debit spread or put debit spread, it's a vertical spread. So when you're trading these vertical spreads, it's a lot easier to middle the market. Middle of the market, it doesn't mean trading in the middle of the bid ask, but well, it means trading between the bid ask, but not like smack dab in the middle. Usually you have to sell a little closer to the bid and buy a little closer to the offer. But moral of the story is you could probably do better than 89 cents. You could probably sell these at like $1.50 and buy these at like 55 and do this for like 95 cents. But, you know, I just want to show you something here that is pretty cut and dried. Oops. I don't know why that says 75 cents. I had John help me with these slides. John's in trouble. I think that should say 95 cents. I'm going to fix it. I'm going to fix that. Just pretend you didn't see that, all right? Would you pretend you didn't see that? I can't change it. It won't let me change it. Hold on a second here. Who cares? Doesn't matter. Okay, anyway. Johnny. Okay, anyway. Making a note here to fire John. I'm just kidding. I'm not going to fire John. Anyway, so let's say that when we put this trade on, wait a minute, where was the stock when we made this trade? It's trading for about 133.57. And we sold this at, say, you know, whatever. Call it 99 cents here. Or call it $1.10. Call it whatever you want. It doesn't matter. Whatever we sold it for. Hold on a second. There you go. We sold it for 89 cents, right? Oh, shit. Maybe I should fire John. What do you guys think? He's got his strong points. He's actually a really great trader, expert in trader psychology. He used to work for Goldman Sachs, for goodness sakes. I can't fire John. I need John. John's great. Okay, so I collect 89 cents. The stock is way down here at like 133. As long as the stock doesn't get up above $140 a share, by expiration, this is what we call a P&L, profit and loss diagram. And this line here represents, it's a snapshot at expiration. If the stock is at whatever price it's at expiration, this will be my profit or my loss. Hold on a second. Still got a thing here. Okay. This will make our profit or loss. So this, if I sell the stock or if I sell the spread, sell the 140 calls, buy the 145 calls, collect 89 cents. If I hold it all the way till expiration and it doesn't go up from 133 above 140, both of these calls expire, worthless. And so I get to keep the 89-cent profit. Trade goes away, the money doesn't. Yay! Okay, good. That means the stock can go down. I mean, it can go down to zero for all I care. I'm going to make my 89 cents if it goes down. It can stay where it is, and it can go up a little bit. In fact, it can kind of go up a lot. It can go up all the way to 140, or let's say 139.99, and I still make my maximum profit of 89 cents. That's pretty good. That is why we call this a high probability trade. We think of trades as being like a bell curve, specifically a log normal distribution. Specifically a log normal distribution with leptokurtotic tails. But we don't got to get that fancy, do we? What that means is that a stock has almost a 50-50 chance of going higher or lower statistically. A little bit of a chance of going higher because a log normal distribution assumes compounding, like you're reinvesting. Which may or may not be a logical assumption. I guess it is. That's what everybody does, so it must be. So we have a high probability of success. If the stock is above 140 at expiration, I'd get assigned on the 140 calls and I'd have short stock. I'd sell it at 140. But I also have an extra 89 cents in my account. So it's really like I'm selling the stock at 140.89. As long as we're below there, we have a profit. It's above there, we have a loser. But unlike a naked call, I have limited loss. Because if the stock is above 145, if the stock is above 145, I can exercise that call and buy back what I sold at effectively 140.89 at 145, and I'd lose only $4.11. Now you look at this and you say, wait a minute, Passarelli, what kind of crap are you trying to pull on me? I can make 89 cents, but I can lose $4.11. I can lose more than 4 times what I make. This is a terrible trade, Dan. You're crazy. Well, you might be right on that. But it doesn't necessarily mean this is a terrible trade. Because we're balancing this risk reward or payoff structure against our probability of success. This is a high probability of success. Right? I was reading Barron's question. Yeah, that's a good one, Barron. I'm going to get to that in a second. And so naturally, you're going to lose more than you can make, right? I mean, what if I spin a wheel, right? Did you ever go to like a VFW hall and they have like that wheel that has like all the nails in it and there's a thing up at the top? It's like Wheel of Fortune. You ever watch Wheel of Fortune? Who do you guys like better, Pat Sajak or Ryan Seacrest as the host? We still have Vanna. Vanna is eternal. But who do you like better, Pat Sajak or Ryan Seacrest? It's a toss-up. Pat Sajak, he's from the Chicago area. Gotta like that. You like Pat, Larry? I mean, I like them both. Don't get me wrong. How can you not like Ryan Seacrest, right? He's like the most charismatic guy that's ever been born. But there's something to be said about Pat Sajak. Yeah, there's something to be said about Pat Sajak. Yeah, the old timers. He's like a legend, a legend. So yeah, let's say you got a wheel at the VFW hall, and Pat Sajak, since he's not on Wheel of Fortune anymore, he's trying to, he's trying to find a job. He gets hired by the VFW hall to spin the wheel because everybody knows he's good at it. So on the wheel, there's only 10 things, right? 1, 2, 3, 4, 5, 7, 8, 9, 10. If 1 through 9 comes up, you win. If 10 comes up, you lose. What if you would have to buy, well, I guess you buy tickets, right? You would buy a ticket for $1. And if 1 through 9 comes up, you get $2. If 10 comes up, you lose. You got to buy another ticket. So basically, you win $1 if 1 through 9 comes up. You lose $1 if 10 comes up. Anybody want to play that game? Anybody want to play that game? I got Pat on speed dial. I'm gonna see which VFW hall he's working at this weekend. You do? Larry does? Juan does? All right. Pat? Vanna, what are you doing at Pat's house? I don't want to start rumors. I don't want to start rumors. I'm going to put that phone right down. We're going to hang up. All right. So, yeah, everybody wants to play that game, right? Because you have a 9 out of 10 chance of winning and a 1-to-1 payout ratio. I want to play that game a million times. You're going to get rich if you play that game a million times. Right? So it's intuitive. Like you would also play that game if you have to pay $5 for the ticket and you win $1, right? Because you're going to win 9 times out of 10. If you play 10 times in a row, you're going to get $9. Or no. Yeah. If you play 10 times in a row, you're going to win $9 and you're going to lose $5, right? You're going to win $4 statistically on average if you play 10 times in a row. So I would certainly be willing to pay $5 to play that game, right? Surely. $5 gets you 10 spins, by the way. Okay, so anyway, there is a natural trade-off between your likelihood of success and your payout ratio. When we have a very high probability trade, we're willing to accept this. But this is just not good enough. We want to get something a little better. What we want to do is we want to slip Pat Sajak a $5 bill so that he can, kind of stop it on our number, right? He can't stop it exactly, but he can kind of slow it down a little bit and make it more likely to hit our number. Wouldn't that be great? You think Pat Sajak would do that? I don't think he'd do that. I think Pat Sajak has honor. Honor. I don't think Ryan Seacrest would do it either. I know Vanna wouldn't do it, but let's just say Pat Sajak is off and it's a guy filling in for him who typically works at the carnival. He would definitely take the $5. So how do we pay off the carny? Well, like this. If we can only sell these credit spreads when they're overpriced, what happens? Magic happens. We get a better credit, a bigger credit, every time because we're selling it for more, right? But the real magic is that that also means our loss potential is smaller because what is our maximum profit? It's the credit we receive. So bigger credit means bigger max profit. But what is our maximum loss? Well, if you're taking notes, write this down. Our maximum loss is the difference between the strike prices minus the credit. So if we go back here, we go 145 minus 140 is $5 minus 89 cents is $4.11. So what if this was $1? Well, then my profit would be bigger. Well, my loss would be 145 minus 140 is 5 minus $1 would only be $4. My loss would get smaller. So when implied volatility is higher, meaning options are overpriced, my credit is bigger, so my maximum profit is bigger, my maximum loss is smaller. I really get a profound benefit when I'm paying attention to volatility. Okay. Juan says the mathematical expectation is positive over the long run, money is made. Right. It's the concept of expected value or expected return. And I accidentally deleted your comment before I answered it. And I might have answered it. Can you throw your comment back there, Baron? How can we determine which options are overpriced? So here's one way. We want to find a volatility chart and just Google it online. You should be able to find a free source for a volatility chart. And if implied volatility is higher than it usually is, well, that's one indication it might be overpriced. As long as there's no volatility event coming out, like during the life of the option, because that would make the implied volatility naturally higher. If implied volatility is above historical volatility, that's another indication that implied volatility is overpriced. Great question. Baron, question when you get a chance. What is the risk reward rate? Oh, what's the risk reward ratio that has the best probability of success for credit spreads? Yeah, that's why I want you to re-ask that again, because that is such an interesting thing to talk about. The answer is there is a very definitive answer for this. And the answer is there isn't one. Anybody who does tell you there is one, they don't know what they're talking about. It's not true. It means that they don't believe in the options pricing model. Because the options pricing model, if implied volatility is 100% accurate, actually is the market's estimate of future volatility and the market's right, every option is worth exactly what it should be worth, and its delta is exactly what its delta should be. Based on Maria's comment earlier, I didn't forget Maria, that delta is the likelihood of an option expiring in the money. So the options pricing model guarantees that no delta option, no risk reward rate is better than any other. Where we get our edge is two ways. One, support and resistance. Two, selling expensive implied volatility. And three, if we can look for, who's talking about whales earlier? Was that Costas? If we're piggybacking off a trade that a really big trader, that some people call a whale, has made, well, I mean, that could also give us an edge. It doesn't guarantee anything, but professional traders don't stay professional traders very long if they lose money on their trades. So they ought to know what they're talking about. All right, Kostas, when do you leave the trade that goes wrong? I am so glad you asked that, my friend. Trade management. So, winners, first, let's talk about where we take our profits. We'd like to talk about the good news first, right? A lot of people look at these and say, well, when the options expire, you make whatever you sold. That's true, but at some point, the risk reward is no longer worth it. So I say close the trades at about 65% of max profit. So, like if I sold that spread at $1, I'm going to buy it back at about 35 cents. Why? Well, because if I sold it at $1, I could make $1 and lose 4. Okay, if it's high probability and I made that trade, that means I thought it was worth it. But once the trade is at 35 cents, that means from here I can only make another 35 cents, but I could lose $4.65. Risk reward at some point is no longer worth it. So I never want to hold out for the last penny. That's kind of silly. 65 cents is a pretty good rule of thumb. I've heard some people say, no, Dan, that's too far. You should do it at 50% or 40%. That's okay too. As far as closing the stock for a loser, or wait a minute, as far as closing the credit spread for a loser, if it goes against you, I like to use a really, really simple rule. One of these two rules is going to serve you great. If the stock gets to the short strike, close it. Might take a loss. You might even take a profit if enough time passed. You made enough money from theta. Or you could be a little bit more conservative and say, if it goes through support or resistance, support if it's put credit spread, resistance if it's call credit spread. Because your short strike should be at or probably more likely lower than support or higher than resistance. So that would get you out a little bit earlier, which is a little bit more conservative. Those are two very, very great rules. But there are some people who say, no, I like to be more conservative and close it closer than that. And that's fine too. But these pretty much represent my rules. Great questions. Each step is part of the system. We want to do analysis and use support with put spreads, resistance with call spreads. We want to use quote unquote technical or a fundamental analysis, which is just reading the news and seeing when earnings is and such. We want to use volatility analysis and only sell spreads if implied volatility is overpriced. And, we want to do a little bit of just a logic screen. Like, hey, does this really make sense? Am I happy with this risk reward? Wow, I've got a huge probability of success. And I'm risking 2 to make 3. Sounds great. Or, hey, I'm selling a little closer to the money. I've got a pretty good probability of success, but I'm risking 50 cents, or no, I'm risking 450 to make 50 cents. Might not feel as good to you. So that's everything I have. I will see you next week, in which we talk about, next week's a great one, how to profit from short squeezes. I will talk to you, friends, next week. In the meantime, trade smart and have a great rest of your day.